Are you new to stock market? Don't have a basic idea about stock market? No worry, I'm here to let you know about stock market. Many people want to make money by investing in stocks. The stock market is a high risky platform. You have to bear if your money loss, but if you invest wisely in stocks, you will get good returns from it. Hi everyone, I am Surinder Karajula. In this video, I am going to explain about stock market basics, especially for beginners. You will get in this video stock exchanges, SENSEX and NIFTY, primary and secondary markets, various types of stocks, stock brokers, Demat account, trading account, and how does stock market works. So why late? Let's begin. Stock market. Stock market is a marketplace where you can buy or sell your stock. Example, Mr. X wants to sell his 1000 shares of Tata Consultancy Services. The stock market facilitates Mr. X to sell his shares. After selling these shares, the amount will get credited to Mr. X Demat account. Popular stock exchanges in India are BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. SENSEX and NIFTY. SENSEX and NIFTY are stock indexes which represents entire stock market. Thousands of companies listed on stock exchanges. So it is not possible to track every company's performance individually. So the index has come into the picture. SENSEX is the index of BSE which represents high market value of 30 companies. NIFTY is the index of NSE which represents high market value of 50 companies. If the index goes up, the major company stock which listed on stock exchange has increased. If they go down, the major company stock listed on stock exchanges have decreased. Primary and secondary market. Capital market can be divided into two parts. One is primary market, second is secondary market. Primary market is a market where security is created. In this market, the company issues shares for the first time to the buyers through the concept of IPO, initial public offering. That means these stocks not traded before. The buyers buy shares directly from the company, not from any other third person. In secondary market, the buyer cannot buy shares from the company directly. They should buy from stock exchanges. The stocks which issued in primary market are get listed. From there, we can buy or sell shares. I will show you with an example. Let's assume XYZ company issued an IPO. That means XYZ listing their shares publicly for the first time. Mr. A subscribed and get allotted 500 shares. Here, A purchased shares but cannot sell his shares to anyone. There is no third party available. Only company and buyers. Once XYZ company shares listed on stock exchanges, Mr. A can sell his shares to Mr. B who wants to buy. Also, A can buy more quantity from stock exchanges if he wants. In secondary market, company not involved. Stocks. We can see four types of stocks. Number 1, equity shares. Number 2, mutual funds. Number 3, bonds. Number 4, derivatives. Equity shares. Equity represents a shareholder's stake in a company. If you buy equity shares of a company, you will be treated as a shareholder and a collective owner of the company. You will get dividend when company issue dividend to its shareholders. Mutual funds are different from equity shares. In this concept, fund managers manage your fund in appropriate way to reduce risk and maximize returns. Your amount will be allocated to different sectors. In equity, you must choose and invest where you want to. But in mutual funds, the fund managers will do it behalf of you. Fund manager allocate your invested amount to multiple stocks. Bonds represent the debt of the company. Company issues bonds. That means seeking amount from the people who buy bonds and pay the interest to them. It is an agreement between the company and the buyer. Derivatives are the specified financial contracts. In equity, share price will go up and go down frequently. To avoid fluctuations in getting profit for both, they may enter into the contract. At a specific time, specific price and specific quantity, the agreement output take place. Stockbrokers. Stockbrokers are the professionals in stock trading. They buy or sell stock behalf of their clients and will get commission and brokerage. The clients raise a request for trading and stockbrokers will do it for them. Investors cannot purchase stock directly from the seller. He or she has to give a request through the stockbroker. Few well-known stockbrokers in India are HDFC Securities, Zerodha and Upstocks, etc. Demat and Trading Account. If you want to invest in stocks, Demat and Trading accounts are mandatory. What is Demat account? Demat account allow you to hold your shares, just like bank account only. In bank account, you can hold an amount. In the same way, Demat account holding shares. Then what is trading account? Trading account allow you to buy or sell shares. You can buy shares of any listed company or sell your shares which hold on Demat account already. How does stock market works? Buyer give a buy request through his stockbroker. The stockbrokers are interlinked with the stock exchanges like BSE and NSE. Once buy request given, amount will debit. The stockbroker handle this order. The stock exchange settle the shares to the stockbroker. From there, shares credit to buyer's Demat account. In the same way, seller give a sell request through his stockbroker. Once sell request given, the stockbroker handle this order. The stock exchange settle the shares from stockbroker. Shares will be debited from the seller's Demat account and credit amount. The fund balance increase. I explained you very basic details about stock market. I hope you like this video. Please subscribe for more videos. Thank you.